When it comes to retirement, do you want to have the same old plan everyone else has? Of course not. You're unique and have your own goals and dreams. Don't be treated like a number. This is your retirement. So it's time to think differently. And you're in luck because you found the Retire Your Way podcast with Dave Lopez, founder and managing member of ILG Financial. At ILG Financial, you won't find generic run-of-the-mill plans containing the same old cookie-cutter solutions. Dave and the ILG Financial team focus on building one retirement plan at a time using their Think Differently philosophy. And that means your own comprehensive plan with customized solutions built to achieve just one goal, yours. So put on your Think Differently hat and get ready to take back control of your retirement today and for all the tomorrows to come. ILG Financial's Retire Your Way podcast was created just for you, and it's starting right now. Coming to you from the ILG Financial Studios, this is Retire Your Way, the podcast that gives you straight talk and honest answers and insight that you need to help achieve your financial goals through smart investing and careful planning. My name's Jeff Shade, and as always, I'm just here to ask the questions, but the words of wisdom and the solid advice come from Dave Lopez, managing member and owner of ILG Financial. How you doing these days, Dave?
I'm doing well. All is healthy. The family's good, and sure looking forward to this new series we've got started together. I'm going to enjoy doing it, and I'm going to enjoy doing it with you, Jeff.
Well, likewise too, Dave. Always good to talk to you here. I learned so much, and I know our listeners learn a lot too. So on today's show, I want to talk about the economic cracks in America's foundation, and today is part one. During this coronavirus epidemic, there's a lot of effort being put into making everything look like it's still great, and it's going to be great in the future. But what people really aren't talking about, Dave, are the massive economic cracks that may be forming beneath the surface.
Boy, you're sure right. And it's important to remember, Jeff, that what's going on now, these are the same efforts that were being put forth in making things look great back in 2007. And everybody knows what happened next in 2007, don't they? And the good news is there is no need to fall victim to these future upcoming events as you might have back in 07, 08 when you may have lost 50%. There's money to be made if you can get ahead of this thing and get on the right side of it before it happens. And we're going to spend some time over the next 3 podcasts talking about how to position yourself to put yourself in the best position to survive this.
There are cracks in America's economic foundation, Dave, and we'll be discussing, of course, in this series, 5 of those major cracks, the 5 economic cracks in America's foundation series. Now, they consist of the potential for another stock market correction, the uncertainty around home equity, the $30 trillion wealth transfer, the dwindling velocity of money, and the silent wealth confiscation. But on today's podcast, we'll be discussing the first major economic crack, so make sure you tune in next week to hear about the other ones. The first economic crack is, will the stock market continue downward?
Yeah, so that's a big question. We've had a bounce back. Since March, we dropped about 34%, depending on which index you look at. And then we had about a 25 or 30% rebound, which we've talked about in previous podcasts. And now it's kind of, for the last week or so, just kind of done nothing. A little up, a little down. And the question is, where are we going from here? Is it going to continue to go up and get us even back to where we were in mid-February and then go to the moon from there, Jeff? Or is it going to turn, as it has done as the usual pattern in most economic drops and recessions? You have a partial recovery like we've seen, and then a bigger drop even further than when we dropped back in March. What I would suggest is there are several market indicators that folks that are behind the scenes looking at the stocks and the market corrections, they look at these market indicators to help them compare what's going on now to what's happened in previous recessions. And let's spend some time just talking about those indicators.
Yeah, specifically, Dave, what are some of those indicators that we should be watching for?
Well, the first one I would point out is we call it the Buffett Indicator. And the reason we call it that is that Warren Buffett says this is possibly the best single measure where the value stands at any given moment of stocks. Let me say that again. Warren Buffett says this is possibly the best single measure of where valuations stand at any given moment. So the Buffett Indicator, Jeff, what it does is it compares the total market value of U.S. stocks. So they just add them all up based on their current stock prices, and they compare that to our government's gross domestic product, which of course is just the value of what we put out as a country in production. What we are experiencing now is that stocks are valued at more than the gross domestic product for the United States of America. Now, what's interesting is this has only happened 2 other times in history. One was 1999, right before the dot-com bubble burst and markets dropped 50%. And the second one, Jeff, was 2007, right before the mortgage implosion when the stock markets crashed 58%. Now, I'm going to kind of go on from that. Notice what we just talked about and the fact that Buffett strongly looks at this, and what he said, it was the single best measure of where valuations stand. As of us looking at this, the last I checked, Warren Buffett has allocated over $116 billion with a B, billion dollars to cash equivalents. And he's hinted that could soar to $150 billion of his money in cash or cash equivalents over the next several months. Now, what's interesting to me about that is that, Warren Buffett, when he's talking to the public, has long been a proponent of what? Buy and hold index funds. Warren Buffett has been a proponent of the everyday Joe, the average investor, buying the S&P or the Dow Jones index funds that track these major indices and then just buying and holding them over a long period of time. I find it very interesting that he's telling everyone else to buy and hold with their 401ks, Jeff, yet he's moving on the order of $115 to $150 billion to cash.
Yeah, I read just recently that Warren Buffett has sold a bit of stock and he's stockpiling cash. And of course, the Oracle of Omaha is pretty much considered to be probably one of the greatest investors ever. So what can we take away from the fact that, he's compiling all of this money?
Right. You don't have to be an economist to see what's going on. If you value his opinion and his judgment, and he's quickly moving a great deal of his assets to cash, that tells you that he believes that the values of stocks and these other holdings are going to dramatically decrease over the short term and give him a chance to buy in at a very low value later. We can't time the market exactly, but we can look at all the indicators, and if we start to see that each one of them is pointing in the same direction, kind of like a weather vane, if we have 4 or 5 weather vanes, Jeff, and they're all pointing in the same direction that says we are overdue for a major correction, that can give you a strong comfort level that maybe you should position yourself to either survive a major correction, and we'll talk about that in future podcasts, how to do that, or maybe we should take a position to either let's protect ourselves from losses from this upcoming change.
Now, Dave, I'm not Warren Buffett. I don't think you are either when we're talking about having investable assets in the billions of dollars. I hope some of our listeners are in that boat, but probably they are not. So, really, should we look at what Warren Buffett is doing and say, well, if Warren does it, I should do it? Or is there a difference between the way Warren looks at things and the way that we should?
That's a great question, and it really doesn't have to do with Warren Buffett because he's a billionaire so much. It really has to do with you never want to make your decisions on how to invest your money based on anyone else. And the reason is everyone, and we've talked about this before, haven't we? Everyone has different goals for their money. So what you should be doing is taking a second or a third look at your goals in retirement. What do you want to accomplish? And then you actually want to prioritize them, Jeff. What's the most important thing that I want to make sure no matter what happens in the stock market, I'm able to do this? And it might be generate, for example, $5,000 in cash for the rest of our life. It might be I want to be able to give $150,000 to my grandson. Whatever it is, we want to be completely clear on what that goal is. Then it's going to be very easy when we're working together to build out a plan to guarantee that happens to you regardless of what happens in the stock market. So that's the long answer. The short answer is, should you do what Warren Buffett does? It depends on if your goal for your 401k is the same as the goal for his huge amount of money. And I would argue it's probably not.
We're talking about the 5 economic cracks in America's foundation with Dave Lopez, managing member and owner of ILG Financial. If you've got questions for Dave, again, that telephone number 540-720-5656. And Dave, I want to continue this conversation, but first I want to talk about the fact that in 2008, your financial world was really shaken up. And, you said you'd never let yourself be vulnerable to huge market losses again. Well, here we are. So I ask you, will you let it happen again? Well, if our listeners find themselves back in an uncomfortable situation, there is something that they can do about it. And right now, our listeners have an opportunity to protect themselves from future market losses while still participating in the upside. And they can create a secure lifetime income stream that you can never outlive. Did you hear that? You'll never outlive this income stream. So get off the Wall Street roller coaster. Minimize your risk and create a lifetime income stream that our listeners will never outlive. To learn more, watch the complimentary webinar Keep Calm and Retire On, available right now by registering at ilgfinancial.com. If our listeners are in a crisis and need immediate help, they can call our retirement rescue team right now, 540-720-5656, or you can contact ILG through the red footer on the website, ilgfinancial.com, and someone will get back to you within 24 hours. Dave, we've been talking about indicators here. The first one we talked about was the Buffett Indicator. So what's another one that we should be taking a look at?
Yes, thanks, Jeff. A second indicator I would keep an eye on is called the Shiller price-to-earnings ratio, and many of you have probably heard it referred to as a Shiller P&E ratio. And what that is, it is just a measure of the price of a specific stock versus how long it will take for that stock to be worth the price that's being charged for it. So I'll give you a great example. In a healthy, normal stock market, the price to earnings ratio is about 16. And all that means is, based on the price of that stock, it would take about 16 years for that company's earnings to equal the price of the stock. So that way, it's just a way we can compare the price of a stock today compared to the price of a stock 10 years ago when the company is at a different size. Well, right now, the average, remember I said in a healthy environment, the P&E should be around 16. That's the average. Well, right now, the average stock has a price to earnings ratio of 33, twice as high as normal. Now, this probably won't surprise you. The only other times we've seen the P&E ratio above 25, and note today we're at around 33, above 25 were 3 times. You want to guess when those were?
Dave, I'd love to guess, but again, I don't want to be wrong, so why don't you tell us?
Well, as you might guess, 2007, the mortgage challenge, just like the Buffett Indicator. The second one was 1999, the dot-com bubble, again, just as indicated by the Buffett Indicator. And there's one more, and it might not surprise you, Jeff, that it was 1929 before the Great Depression.
Oh. I was going to say that, Dave, but I thought I'd let you say it.
Yeah, so remember, these are just indicators. But just like if you're reading a weather report, if you start to see multiple different indicators pointing in the same direction, all we're saying here is the more weather vanes that point in the same direction, Jeff, the more your ears should perk up and you should take notice.
So with this valuation being what it is, Dave, I think it's pretty fair to say that the market has been, or at least the stock market, has been overvalued at 30 times price earnings ratio. So is this an indicator that we should probably just stay out of the market until things come down quite a bit?
Well, that's a great question. So, I wish I could answer it in one sentence, but again, it goes back to what your goals are for your buckets. And a short answer would be, I'm not adverse to staying in the market if you're willing to leave that money untouched for 10 or more years. And we can talk a little later about where we get that number, but frankly, Warren Buffett says the same. He said, if you're not willing to be in the market for 10 years, no matter what happens, you have no business being in the market for 10 minutes. Well, what we're talking about here is the market, these indicators are suggesting, could make a major correction. And I believe that eventually they will recover, because it always has, but it could take 10 or more years to recover. So if you've got money that you're willing to leave for 10 years in retirement or more, then we might consider a buy and hold strategy. If on the other hand, you've got money that you can't afford to leave or have no interest in leaving for 10 years untouched, which makes perfect sense if you're 65, you don't want to take money you've spent your life saving and now put it on the sidelines from 65 to 75. You might be too old to enjoy it at 76. Right? So if that's you, then all these indicators are saying is, hey, maybe the market's not the best place for money that I may not want to leave on the sidelines for an extended period of time.
That's Dave Lopez of ILG Financial. Again, the phone number there, 540-720-5656. In this podcast, we're talking about some economic indicators insofar as economic cracks go. And we've talked about the Buffett Indicator, the Shiller price to earnings ratio. Dave, what is another indicator that we want to take a look at?
Well, the next one that's very telling is called margin debt. Now, margin debt, that sounds very confusing, but it's really quite straightforward. It's the amount of money being borrowed and used to invest. So an easy way to talk about that would be, most folks think of investing as, hey, I've saved $10 and now I'm going to take this $10 and in a chance to do better than the bank, I'm going to invest it in a stock and try to get a better rate of return. Is that reasonable, Jeff?
On the surface, yes.
Yeah, that's how most of us invest. Well, there's another group of people and companies and entities that literally borrow money so they can invest more in the market. So instead of just investing the $10 they saved, they'll go out and get a loan for $1,000 and invest that money in the market, which works very well if the market goes up. But if the market tanks, not only do they lose all of their money, but now they've got this debt. Imagine borrowing $300,000 on your house, investing it in the market, then losing half of it and still having a mortgage payment on $300,000. But it's done all the time, and it's called margin debt. So one of the indicators we've got is we can take a look at how much money is being borrowed for margin debt to be reinvested in the market. So again, margin debt is the amount of money being borrowed to invest. The first 2 times the margin debt breached 150%, and all that means is that the margin has grown faster than the stock market, was 2007 and 2000. And in both situations, we had a market correction, as you know, of 50% or more. So when the debt reached 150% in 2014, that was an exception. The market kept going up. What's happened now is the amount of money being borrowed to invest, the margin debt, has gone through the roof. It is abnormally high. The margin debt ratio has breached 150%, which means that the margin has grown faster than the stock market. And that has happened only a couple times. It happened in 2000, it happened in 2007, and it also happened in 2014. Now, in 2000 and 2007, what you saw is major corrections, 50% collapse or more in the market. Now, when the margin debt breached 150% in 2014, interestingly, the stock market just kept going up. Now, the result is here in 2020, we are now at the highest level of margin debt in U.S. history. Let that sink in. We are at the highest level of margin debt in United States history. And that means when it starts to pull back, when the market starts to pull back, these people aren't just going to lose the $10 they invested. They're going to be risking losing the whole $300,000 mortgage. So they are going to panic and try to sell. And when everybody is panicking and selling, that's what creates a market collapse.
We're talking about indicators of an economic crack here and the Financial Foundation of America. Dave, what's the next one?
So the next one I would say is keep a close eye on what we call stock buybacks. So we've looked at 3 indicators or 3 weather vanes right now, all pointing in the direction of a market correction and a major one being on the horizon. The 4th one is called stock buybacks. Think of it this way, Jeff. There is an exclusive group of buyers who were actually, and a lot of folks don't know this, were banned from buying stocks because they triggered the 1929 stock market crash. And in that period, the stock market dropped by 90%. Do you know who this group of investors were?
I do not.
They are individuals or groups acting as companies, buying their own shares of their companies on the open market. And the reason they were banned is because in 29, basically the entities that were regulating said, look, in hindsight, they were artificially manipulating the share price of their stock by creating artificial demand for their own stocks. So think of it this way. Coke doesn't like the price of their stock. So what they do is they actually go out and borrow money. They sell bonds to you and me, but they take that money and instead of using that money to open a new plant or expand their business and grow it, they take that money and buy their own stock. But they're buying so much of it that the price of the stock goes up. So what you're seeing is the price of the stock artificially inflate. And then you and I are at home and all we see is that the price of Coke went up and we said, oh, Coke's a great company. The price is going up. I better get on the bandwagon. So we always want to be leery of anything that artificially props up the economy or artificially props up an individual stock, because sooner or later you take away that artificial prop, and just like with a stool, if you take away an artificial leg, everything falls over.
We've been talking about the 5 economic cracks in America's foundation here. This is part 1 of a 3-part series with Dave Lopez of ILG Financial. And Dave, we're going to wrap it up for today. Next time, we're going to be be talking about what should we do? How should we react to this? So for Dave Lopez, I'm Jeff Shade. Thanks for listening. We'll talk to you again next time with another edition of Retire Your Way. Have a great day.
The information provided is for educational purposes only and is not intended as investment advice for any individual or entity. All information contained herein is believed to be from reliable sources. However, we make no representation as to its completeness or accuracy. The views presented today are those of Dave Lopez and not necessarily represent the views of AlphaStar Capital Management, LLC. The opinions expressed are subject to change without notice and do not constitute financial, legal, or tax advice. Please consult your financial professional before executing any financial strategy. Investment advisory services offered through AlphaStar Capital Management, LLC, an SEC-registered investment advisor. SEC registration does not constitute an endorsement of the firm by the Commission, nor does it indicate that the advisor has attained a particular level of skill or ability. AlphaStar and ILG Financial, LLC are independent entities.